The conflict in Iran has certainly raised some uncertainty in markets and led to greater volatility in markets than what we've seen for a while. And that's definitely why we espouse taking a longer term view, making sure that clients try to move away from the distractions of what happens in the short term. And it becomes very noisy, so it becomes very disorienting and challenging to face into. It doesn't always impact what happens with businesses and economies and what happens over the longer term. And that's why we always try to message and make sure that clients are focused on the long term. They're trying to fund retirements and fund lifestyles for a long period of time. And so these short-term uncertainties are things that we need to work with and stay quite diligent and disciplined around. If we talk more deeply about what's actually happened in the Middle East and impact for markets, clearly the first order effect there is on energy markets, specifically around oil, LNG, and also then fertilizer and other related outputs or inputs, I should say, for primary producers, where the Strait of Hormuz is one of the largest areas for traffic to transport some of those primary products out to the global economy. And so the effective closure there, and there's very small numbers of transport traffic going through. The impact there has clearly had an immediate impact to oil prices and other energy prices, which is a primary input cost for many parts of what is required to be produced around the world. And it is a global impact. As much as the US is a producer of energy itself, it's still impacted by global oil prices, which then has the flow on to inflation and second and third order inflation impacts, which is what the market's now trying to guess what happens next. Generally, most markets have been off by 4 to 5%. Which, if you look at the headlines on a day-to-day basis, you may have thought that it was worse than that. It's not fantastic, but it's still not as challenging as maybe a 10 or 15% downturn in a short space of time. So markets are looking through. The main guess or uncertainty that comes into this at the moment is the extent or the time frame that the conflict's likely to go on for, which clearly has a flow on in terms of the uncertainties around energy prices and what that means for inflation. But generally, markets were looking through the conflict, looking through what the impact may be for balance sheets, for profit and loss, and for what the impact may be for companies. And broadly, it was a sort of a 5% pullback for most equity markets around the world. So clearly the energy companies were positively impacted. So where they've got a product to sell to market, they're getting higher prices for that, and something in the order of sort of 40, 50, 60% higher prices. That probably is likely to be a short-term piece. So if they can lock those prices in, it's great, but it's more a short-term thing. And there's a lot of futures and a lot of hedging that goes on in this space as well to try to protect from some of these inflation spikes or to lock in prices if you are one that's producing these. So some people will win out of this from an energy company perspective. Clearly there's a rotation also into some of the more defensive sectors as well. So infrastructure, staple companies, telecommunication companies have performed relatively well in this period as well. Flip that around and clearly the IT companies are still ones that are facing into challenges. And I think some of that's still down to probably the AI talk and how long the AI boom goes for and how much money is going to continue to be spent in this space. At the moment, it seems like a bit of a bottomless pit in terms of how much money is getting spent to build the infrastructure and build the software and the capabilities. That will stop at some stage. There will be some winners out of that at some stage, and at the moment there's a lot of money being spent, which may still be a little uncertain as to where the returns will come from for those assets. Other trends we saw in the month as well were some of the, I suppose, differences that we're seeing in other asset classes as well. So clearly equities were down in the period. You look for other assets to try to ballast portfolios through that period. Infrastructure is one of those, has been performing quite strongly over the last couple of years and continue to do that through this period as well. We've had clearly that inflation expectation lift, and many of the assets in that asset class are linked to inflation-linked income streams. Pretty defensive, monopolistic type assets where you've got confidence around the patronage or the usage of those assets. So they have held up relatively well, and that's a good part of a defensive portion of a portfolio. Flip that around with other real assets, and property was a little challenged, and I think that's related to interest rates and the expectation that rates are probably likely to increase a little bit from here. They're more sensitive to interest rate markets, probably a little bit more so than the inflation benefits that you get with infrastructure assets. Short-term cash rates are probably expected to go higher with the inflation impacts of what's going on with the conflict. And that's one thing that the central bankers will have a bit of a challenge with, is trying to interpret how long that inflation impact will be in markets for. Clearly we've had some positive outcomes from inflation over the last couple of years, and central bankers' work had largely been done. Now with this spike in inflation coming through from energy, it's a challenge that they'll have to front into to understand how much further do rates need to increase to stem what inflation will be there, even though I suppose the higher energy prices are a bit of a tax on people anyway. So you might get a double whammy with an interest rate increase as well as the higher cost of petrol and other fuel inputs. Think about broadly other fixed interest markets. So it's quite an interesting dynamic with the conflict, and generally you would expect those sorts of assets to perform well. So there's the defensive characteristics from bonds, that's a bit of a safe haven in these sorts of times. Whether markets are looking through it, but also considering the longer term inflation impacts. We actually saw longer dated interest rates increase, which is negative for prices. So you'll see a little bit of a pullback in some of the value of those assets. Starting yields for those assets now are quite appealing though. So in Australia, it's almost a 5% interest rate for government bonds. AAA rated securities, one of the best rated governments around the world. It's not a bad starting point for an interest rate if you're looking for a defensive home for assets. Investing is knowing that there is uncertainty in markets, and you can't avoid uncertainty. We know that it's around, and we know that it'll show up at difficult times, and it's taking a long-term view when uncertainty does show up. So making sure that we're not making decisions that are short-term oriented and going to impact what the benefits of long-term investing are, and that is generally staying the course and pivoting if there are massive changes that do happen into the fundamentals of what's going on in markets. So the goal with investing is not to avoid uncertainty, it's to stay disciplined and diversified when uncertainty shows up.